This year, facing the political unsettlement such as UK has activated the Brexit and Scotland also claiming to ditch from UK governance. Many investors want to know what will affect the bond product. And today we invite an expert from Aberdeen Asset Management is Ben Pakenham. Ben, could you tell our investor what is your observation on the impact of bond products?
Yeah, I mean, I think it's very early to tell. Obviously, we've only just triggered Article 50 last week. The positive news with regards to Brexit is that since the UK voted to leave the European Union in June last year, the economic data out of both the UK and Europe has surprised to the upside, which I think is very positive. Now, clearly that may change in the future. There's a huge amount of uncertainty and a very long lead time before we actually eventually leave the European Union, likely to be 2 years from now. So a lot of potential for, perhaps some volatility in both the economic data and financial markets. But I hope that ultimately a deal will be reached between the two parties that is beneficial for both the UK and for the European Union. And you have to think that it's not in anyone's interests for the negotiations to be too acrimonious. So that is the hope. With regard to Scotland, this is obviously very new news. The Scottish Parliament just voted to have a referendum again on Scotland leaving. Last time, as we know, they voted 55% of the population voted to stay. And I personally hope that they choose the same outcome. But again, I think it's really too early to have a view on whether which way the referendum will go and what effect that would have on financial markets.
And do you see any potential opportunity on the bond market?
As a result of Brexit? Again, not particularly. I think one thing we saw post-Brexit was that monetary policy in the UK was eased slightly. So there was an immediate cut to interest rates, which may have perhaps contributed to the economic data being stronger than we expected. Longer term, I hope that maybe Brexit will encourage actually an even closer Europe or an even closer European Union because of the shock perhaps to the Europeans from the UK voting to leave. But I think again it's too early really to decipher whether there are opportunities there, but it's probably in the short term a good thing for bond markets as monetary policy remains relatively loose.
Okay, so, and we talk about the Europe, and what about the US? Because Taiwan investors, they tend to have US bond products more than Europe.
Yeah.
So compare the US and Europe. What is the advantage and the disadvantage?
Sure. I think more than ever the two markets are very different. The long-term correlations between the US and Europe have been very, very high. So I think the 10-year correlation has been around 90%. That dropped as low as 50% in 2015. And I think there are two key reasons for that. One is that the energy market was the largest sector within the US, whereas it was a very small sector in Europe. So as the oil price fell, we had very little sensitivity to that in Europe. In fact, as net importers of oil, that was broadly a good thing for many of the companies that we invest in. Whereas in the US market, that caused a big drawdown in the energy sector, which hurt bond prices there. The other key point, I think, when comparing the two markets is that we have diverging monetary policy. Quantitative easing has finished now in the US, and they've actually started to raise rates. They began their rate hike cycle in December of 2015, and recently in March last year, they hiked rates again. So the key importance there is that monetary policy remains looser in Europe, which should be a positive for bonds. But also there's been a big divergence over the last 3 or 4 years between underlying government bond yields in the two regions. So today, broadly, US yields are about 6%. The European market yield is about 3%. For the high yield markets. But the majority of that difference actually comes from the difference in the underlying government bond yields, which is an important consideration. Finally, the quality of the US market is actually lower. So the average rating in the US is B+, The duration is also about 1 year longer. So ultimately, all of those things that I've just mentioned mean that the US market is a more volatile market than the European market, although obviously the yield is also lower. So I think if you're buying the US market, you're taking more risk, frankly, as things stand today.
So Ben, facing a lot of uncertainty in the market, what is the main consideration for bond investment?
I think one has to differentiate between the different types of bonds. So you have obviously government bonds on the one end and you have high yield bonds on the other. As a high yield investor, I think the most important consideration really is the outlook for default rates. Now that can be a function of many things. It can be a function of the indebtedness of the companies in the market, or the growth, the earnings growth expectations of the companies that we invest in, which will also be, frankly, a function of the economic growth environment. So the macroeconomic picture is very important. You also have to consider how strong capital markets are. At the moment in Europe, we have very strong capital markets, which means refinancing risk is very low, but also the cost of debt has never been lower for high yield companies. And therefore, again, default rate expectations remain relatively low in the short term. Finally, you also have a very supportive monetary policy backdrop, which means that the money supply is relatively strong, which is also generally good for bond investing. With regards to government bonds, it's quite different. There you're really looking at what inflation expectations are. Inflation is generally a bad thing for government bond investing. It's not necessarily a bad thing for high yield bond investing, but also again, what the central bank is doing. So we've been in a period of unprecedented central bank support in Europe. 5 years ago, almost to the day, Draghi said he would do whatever he needed to do to support the euro. And since then, he's done many things, including quantitative easing, which have helped suppress government bond yields. So I think those are the important considerations.
So Ben, you compare the US bond with the Euro high yield bond. Why you choose the Euro high yield bond? What is the characteristic of this product?
Yeah, I mean, I think, again, some of the points I just made, I think it's a more defensive product today. So it provides a decent income. The income yield of the European market is 5%. The yield to worst is lower because bond prices are trading above par. But you do have low duration, which means low sensitivity to government bonds. Government bond yields have been increasing since Trump was elected president of the United States last year. We are less exposed to that move. You also have a more supportive central bank at the moment. Quantitative easing is still ongoing in Europe, and there is no risk of rates going up anytime soon in Europe, which again is broadly supportive. Finally, economic growth is actually starting to pick up eventually in Europe, which is a good thing. It could be close to 2% economic growth for 2017. And I would add to that as a result, default rates remain very low. European default rates are expected to be 1.5% for this year. They may be double that in the US market. So the US market has good characteristics as well. It's higher yielding, but I think with that yield, you are taking incremental risks.
And Ben, so what is your investment strategies?
I always say that I think about 80% of what we do is bottom-up investing, stock selection, and about 20% of what we do is macro or top-down. So when we look at a company, we're trying to decipher what the cash flows of that company are going to be like, whether they generate a significant free cash flow yield as a percentage of debt, whether they intend to deleverage their balance sheet, which is a good thing as a bond investor, what their market shares are, what their competitive advantages are, what their barriers to entry are. We also do a lot of work on the covenants. We have an on-desk lawyer at Aberdeen who siphons through all the bond documentation and tells us whether or not we are safe in the investment we're making, or whether or not there is the ability for the company to make equity-friendly decisions, such as re-leveraging the balance sheet in order to pay dividends, which is a risk that we don't want to take, particularly as high-yield investors. The top-down aspects of what we do are more to do with whether we want to be overweight or underweight duration, either spread duration or interest rate duration. which sectors we think are more attractive than others, and whether we want to have investments in defensive sectors or cyclical sectors, and also considerations such as country risk. So today, for example, we have underweights in France and quite a significant underweight in Italy, but a large overweight in the UK, where we think the bottom-up analysis suggests that those are relatively attractive investments.
So, Ben, could you share for like one example, like one company is in your portfolio, and how you find this company and why you choose to invest this corporate bond?
Yeah, sure. Off the top of my head, I'll actually think of a refining company. There's a company called Coral Petroleum, which is a Swedish refiner. That's been a volatile history for that company, but it has very large market shares. Their biggest asset is a very high quality asset. And at the moment in Europe, refining margins are extremely strong. They have been for a few years, partly because of outages at the Atlantic basin, but also because of other reasons. Therefore, the leverage today is relatively low, probably sub 3 times debt to earnings, and the cash flow generation of the company is very strong. The bond also has an 11% coupon, which is an enormous coupon in this environment, and trades at about a cash price of 105. So the yield of 9 or 10% is extremely attractive relative to the yield in the market. The final point I'd say about this company is that it looks very cheap when comparing it to other corporate bonds in the refining sectors, particularly when you compare it to refineries in the US. So we think that there is further capital appreciation opportunities in that bond today.
How is your portfolio performance so far? Could you tell us?
Yeah, so I joined Aberdeen in September 2011, not just in terms of the returns that we've generated for the investors in the funds, but also in terms of the volatility that the fund has displayed, which has been lower than the market. One of the reasons for that is the stock picking, I think, has been very good. And we pride ourselves on the micro analysis that we do on every company that we invest in. But also since the middle of 2013, when we had the taper tantrum, we actively decided to build a position in short duration, short call bonds. Today we think about 25% of the fund is invested in that part of the market, which means that over the next year we expect 25% of the fund to repay. And that massively reduces the volatility, but also provides a nice income because they're old legacy high coupon bonds.
How many people in your research team?
So we have 5 analysts. On the European side. We have 5 analysts, a lawyer, and myself and Steve Logan co-manage the funds. So we're a team of 8, which I think is ideal.
How you work together? Do you you have a meeting every morning or?
Yes, we have a lot of meetings. It is very much a team-based approach. So the analysts are split up by sectors. So they are sector specialists, which I think is extremely important. We'll do a deep dive team meeting on every company that we're looking at. And we encourage everybody to have a view on the credit. We will ultimately decide as a group whether or not we think the bond is, or the company that we're looking at is investable. And then finally, at what price we think the investment is attractive, and then go from there. But we have many weekly meetings. We have numerous weekly meetings that I won't bore you with all of them, but there are a lot.
What if your team member have the upside opinion with you?
Good question. Well, we'll have a debate. I mean, we actually like that. The last thing we want is for everybody to agree all the time. In my opinion, a strong, functioning, efficient team is a team that fights occasionally and has a difference of opinion. If everybody always has the same opinion, I think that's very dangerous. So generally we try to be a democracy, but if myself or Steve or both of us have a very strong view that is different to the analyst, ultimately the portfolio managers have the final decision.
So Ben, we want to know what is the outlook of Euro high yield bond?
Yes, I think today, given where yields are, the yield is relatively low by historic standards, even though the spread actually is still quite wide. So the spread today is 350 basis points. It has been as low as 150 basis points when the market was much smaller in 2007, and actually the quality of the market is lower. So we think spreads are fine, but what we really think that protects you from is both default risk and rising government bond yields. We think the opportunities for capital gain at a market level are relatively subdued, but we do think that the income is very safe because the default rate expectations are so low.
And Ben, last year we see Donald Trump, and he won the U.S. president election. What about this year? Is any unpredictable black swan again in the market or in any country?
Yes, that's a great question. I think people are very worried about the rise of populism, as people call it. We had Brexit last year and we had Trump last year, both of which were unexpected by financial markets. The reaction by markets to both events was probably also unexpected, in that markets have responded very positively, which is perhaps surprising. So you never know actually what the event will be or how markets will respond to that event. With regards to the upcoming political elections in Europe, well, we're not actually that concerned about the political risk at the moment. We just had Dutch elections, which were a quite resounding defeat for the anti-EU far-right Freedom Party in Holland, which suggests that perhaps populism isn't gathering quite as much steam as people think. The next political hurdle in Europe is the French presidential election. Le Pen is very likely to get through to the second round. The question at this point looks like, who will she face? Will she face Fillon or will she face Macron? I think from a market perspective, we would prefer that she faces Macron. Most people expect Macron to win the second round quite comprehensively against Le Pen if it gets to that. And we do expect Macron to get through to the second round. If Fillon gets to the second round, it may be slightly trickier because the left may not vote for Fillon. They won't vote for Le Pen either, but the turnout will be lower, which might play in Le Pen's favor. But broadly, we're hoping for a Macron versus Le Pen, and we ultimately expect Macron to win the French election, which would be good, we think, for high yield in Europe. After that, you have the debt refinancing for Greece. There's been a preliminary agreement, and Greek assets have been rallying recently, which is, again, a good thing. And then later in the year, I think September, we have the German elections, but both of the main candidates there, Merkel and Scholz, are pro-Europe. And again, we don't see much risk. Neither of those are populists. Finally, at the end of the year, or probably perhaps early next year, we'll have an election called in Italy. And again, there's a risk there because the five-star anti-establishment, populist, if you like, party has been gathering momentum over the last few years. But again, we're not so sure that they will win that election. In fact, we think it's quite unlikely. They are not experienced at running governments. And in fact, the mayor of Rome, Raggi, who is a five-star MP, has done what I think Italians think is a relatively poor job in Italy, which probably has lost some credibility for the five-star movement. So overall, we think that political risk is probably slightly overplayed at the moment, particularly by journalists. Actually, markets have been reacting in a relatively benign fashion.
Most of the risk you mentioned is in Europe. And what do you see about the euro compared with the US dollar? I mean, the currency rate.
Yes, I try to avoid giving advice on currencies because I'm not a currency specialist. Clearly the euro has depreciated against the dollar quite significantly. There is recently some suggestion that Donald Trump may find it harder than expected to push through some of the policies he wants to, which would probably be bad for the dollar in the short term.
Yeah.
And if we're right that the political risk will recede throughout the year, that should probably be quite good for the euro currency as well. Having said all that, we always encourage investors to invest on a currency hedged basis, because as we've seen over the last 12 months, currency risk can completely dwarf the credit risk. And we ourselves always hedge currency risk within the funds for that reason.
For some bond investors, it's better to choose US dollar or euros.
Well, I think the US dollar is more closely linked to the Taiwanese currency. So for that reason, it's probably a better hedge, I would have thought, than investing in euros. But for the reasons I just gave, I think perhaps in the short term, the outlook for the euro may be slightly better than the dollar. But that's really a short-term trade, and I don't have a particularly strong view.
Okay, thank you, Ben.
Thank you very much.
Excellent, and we hope to see you here soon again.
Absolutely. Thank you.
Thank you.